p.m., so we'll see how this is going to go. This was the compromise time. Shall we get ourselves going? But before I tap the pretend gavel, I'm going to try to say this 2 or 3 times, and I even said it in the back of the room. For many of us who've been around this for a while, I think I hold the record of being the very first person to use the word Bitcoin in the congressional record. I think it was 2011, Ron Paul's Monetary Oversight Subcommittee in Financial Services. And no one had any idea what I was talking about, but I had like a Wired article about it. And here we are a decade plus later. Now our job in this committee, I'm going to say it 2 or 3 times, I'll say it as part of the opening statement, we're the tax writing committee. We're going to try to figure out now, as the committees with the regulatory oversight, financial services, the Senate companion, make the rules, we now have to figure out how it fits into the tax structure. And I will beg from both of our members, the witnesses, help us on the tax regulatory, the recognition of an asset, recognition of gain, rule set. If someone really wants to spend their time going back and forth on the regulatory aspect, I do suggest they ask for a transfer to the Financial Services Committee. So let's have let's have at this. Good morning, everyone, and welcome to the Oversight Committee of the Ways and Means for the 119th Congress. We're actually trying to focus on ensuring digital asset policy for this century. Thank you for joining us for this discussion. While much of today's hearing will be focused on examining this evolving industry and discussing potential policy solutions within the committee's jurisdiction, it also is important to note the complex relationship between digital assets, traditional assets, and how we equalize and create a sense of fairness in its tax and our side of the rules, so we don't create also artificial arbitrages. Even today, more and more companies are exploring ways to use crypto assets in their treasury management and their hedging book. This is something we have a great interest in, and so help us understand both those management strategies and how they will also fit into a tax regime. Currently the Internal Revenue Service Code defines crypto as a property, not currency. However, there are very few additional rules specific to digital assets, leaving many stakeholders often confused when it comes to the tax complications. That is our fixation here. Help us create at least our understanding so the brilliant staff sitting behind us, both on the left and the right, can actually help us build the rules, the code, and what the future looks like so we have stability. So if innovation's going to come, that innovation isn't coming because it's a tax leakage or there's an arbitrage there. We're really trying to make sure we understand what we're doing here. Additionally, and equally as important, we must use today's hearing to learn more about what Congress can do to help retain the leadership of this evolving industry, these digital assets, into this, keeping them in this country. Also, aligning the tax code with the regulatory certainty all but ensures America becoming and remaining the crypto capital of the world. I look forward to the discussion. Often when I have the benefit of sitting in the chair, I'm going to do something slightly differently. I'm going to save my questions to the end because sometimes there's one of the beautiful things about this committee is we have some folks who are actually somewhat more technical on this subject area. So I will ask all of you to be at your A game as we sort of go through this. So I'm going to introduce our witnesses, and then let's have at it. You don't want to introduce your witness. Now you want to, no, Ms. Swoop.
Thank you, Mr. I want to thank all of our witnesses for being here today. The timing of this hearing and this week's floor activity is not lost on me, House Democrats or American people for that matter. We are less than 2 weeks away from the single largest transfer of wealth from working Americans to the top 1% in the One Big Ugly Bill. While billionaires and millionaires receive extensive tax cuts, House and Senate Republicans have taken health care away from 17 million Americans. This should not be lost on any of us, especially those of us who represent rural America in states that didn't expand Medicaid. Our rural hospitals are really a quite concern. Despite these dire consequences of the new law for Americans, House Republicans are trying to turn the public's focus to digital assets. Republicans are, or at least attempted to yesterday, bring the Clarity and Genius Act to the floor this week, but have no luck so far. As ranking member, I agree that Congress needs to examine digital assets as a whole and look forward to discussing the tax treatment of digital assets, including cryptocurrency, with you all today. I think it's really, really important that we as Americans lead in this area. I can tell you that over the 14 years that I have been in Congress, the rate in which digital assets have gone from niche blog posts to the front page of global publications is something to behold. It is undeniable that digital assets, including cryptocurrency, have transformed digital payment and investment. As digital assets take a larger role on the world stage, it is important that we protect consumers, we remove bad actors, and that we ensure fair tax treatment for all. We must work to strengthen rather than weaken the guardrails in place to protect Americans. Earlier this year, President Trump launched his own meme coin. The media has reported that these coins have no intrinsic value, but have netted him over $300 million in fees. It is alarming that 80% of the coins market were held by the Trump family and its partners. I came to Congress to fight for families in my rural community of Alabama, and not to further aggrandize the president. I think all of us could agree that it's pretty alarming that anything that we do will have direct consequences on our president and his family. And it's something I think that we need to put guardrails on for the future. With that, I am excited to hear from all of our witnesses, and I yield back the rest of my time.
Thank you. All right, our witnesses. Summer Mercer is CEO of Blockchain Association. Sarah Reilly is Vice President and Senior Counsel at Fidelity Investments. Alison Mangiero is Head of Staking Policy and Industrial Affairs at the Crypto Council for Innovation. Jason Somensatto, I was sort of close, is Director of Policy at Coin Center. Corey Frayer is Director of Investment Protection and Consumer at the Consumer Federation of America. Frayer. See, that's why I wanted her to introduce you. All right, you each have 5 minutes, and then when we get to questions, we'll go back and forth and see the education of members of Congress and our staff. Please have it.
Thank you, Chairman Schweikert, Ranking Member Sewell, and members of the subcommittee. My name is Summer Mersinger, and I'm CEO of Blockchain Association. We're the leading collective voice of the digital asset industry in the United States, representing more than 130 of the most innovative job creators and stakeholders in the blockchain economy. Our members, many who are startups and small businesses, are developing the next generation of the internet and financial infrastructure here in America. From software developers and infrastructure providers to investment firms and trading platforms, we are proud to advocate for the responsible growth of this transformative technology. To ensure that growth and innovation happens here in the U.S., Congress must provide clear, workable tax rules for digital assets. Our tax code wasn't built for this kind of innovation, and the result is costly confusion that harms consumers, small businesses, and overwhelms the IRS. Right now, every digital asset transaction, no matter how small, is a taxable event. For everyday users, this is unmanageable. For businesses, critical blockchain activities like staking or token upgrades lack clear guidance, creating legal risk and pushing development offshore. The situation is made worse by burdensome new reporting requirements. The IRS itself says it expects up to 8 billion new 1099 DA forms annually. By our estimate, complying will cost the U.S. taxpayers around $250 billion and add 4 billion hours of paperwork each year. To put this in perspective, this single rule could increase the entire federal paperwork burden for American taxpayers and businesses by approximately 33%. Our industry supports tax compliance, but it must be achievable. We respectfully request that the committee provide much-needed clarity and support American innovation by considering the following priorities. First is exempt de minimis gains and losses from taxation. Clarify the character, source, and timing of income for mining and staking rewards. Clarify certain digital asset transactions are non-recognition events, including wrapping and unwrapping a digital asset. Adopt legislation to allow staking in the U.S. digital asset investment structures. Extend the mark-to-market accounting method currently used by commodity dealers and traders to digital assets. Establish a new safe harbor for foreign persons trading in digital assets. Provide non-recognition treatment for gains or losses upon the digital asset transfers in connection with qualifying loan transactions. Allow charitable deductions for digital assets easily valued or regularly traded without requiring qualified appraisal. Reconsider the provisions of the Infrastructure Investment and Jobs Act that create barriers to the development of the digital asset industry. Allow digital assets to be held as investment assets and retirement accounts. Ensure that any update to wash sale and constructive sales rules for digital assets only pass as part of a comprehensive digital asset tax package. Make research and development eligibility for blockchain development explicit. Digital assets represent a transformative opportunity for the American economy, but without modern, fair, and practical tax rules, we risk losing that opportunity. Blockchain Association and its members are eager and willing partners in this effort. We stand ready to serve as a resource to you and your staff. Thank you for your time and leadership on this critical issue, and I look forward to answering your questions.
Chairman Schweikert, Ranking Member Sewell, and members of the subcommittee, thank you for the opportunity to share Fidelity's perspective on digital assets and the importance of implementing a modernized tax framework. We also appreciate Chairman Smith and Ranking Member Neal's focus on this issue. My name is Sarah Reilly, and I'm Senior Tax Counsel at Fidelity Investments based in Boston, Massachusetts. For over 75 years, Fidelity has been customer-obsessed. Where our customers are committed to investing, we build solutions to support them and believe a customer-centric regulatory model is critical. We have nearly $6 trillion in assets under management and are one of the country's leading workplace benefits providers and America's largest IRA provider. Fidelity offers a unique perspective in the digital asset space. As one of the only established large financial institutions in the digital asset ecosystem, we are a bridge between traditional finance and digital assets. We began research and development on digital assets in 2014 and have offered custody and trading of Bitcoin since 2018 to support our institutional customers' needs. 3 years ago, we launched Fidelity Crypto for retail investors, which provides custody and trading of Bitcoin, Ethereum, and Litecoin. In 2024, following SEC approval, we launched 2 exchange-traded products, the Fidelity Wise Origin Bitcoin Fund and the Fidelity Ethereum Fund. These products provide greater optionality and ease of access for our customers who wish to have investment account exposure to digital assets. Our commitment to digital assets is firm-wide. We believe blockchain technology and digital assets will play a transformative role in the future of finance. Similar to other pivotal technological advances such as the internet, this technology is an integral part of the evolution of the financial sector. And for that future to be realized, we need a clear fit-for-purpose regulatory framework, one that fosters innovation, reflects the unique attributes of digital assets, and above all, protects investors. We are encouraged by the recent progress in Congress toward establishing such a framework, but a modern regulatory framework is not complete without a modernized tax code. To support the growth of the digital asset ecosystem, including stablecoins and decentralized finance, tax rules must keep pace with technological innovation. While digital assets may share characteristics with other types of assets, they are distinguishable in ways that necessitate change to the existing tax framework. Further, the use cases for digital assets are expansive, including being used for payments for goods and services, investments, governance, and for decentralized finance applications. This breadth demonstrates the need for thoughtful and tailored tax rules. The crypto industry urgently needs clear, consistent, and administrable tax rules. Tax certainty supports industry growth and encourages business activity to grow domestically rather than offshore. In the absence of comprehensive guidance, taxpayers and institutions are left to rely on general tax principles and sub-regulatory guidance which fail to address the full scope of new challenges and complexities introduced by digital assets. This uncertainty has real consequences. It undermines taxpayer confidence, it results in inconsistent taxpayer outcomes, it makes compliance more challenging, it pushes innovation offshore. For example, ambiguity around the sourcing of digital asset staking rewards has already led to a significant shift of staking activity outside of the US. Tax legislation is needed to both update the existing code sections that should address digital assets, such as those relating to securities lending, mark-to-market elections, and US trading safe harbors, and to deal with novel concepts in the digital asset space, such as staking and stablecoins. Most tax code provisions were written before the broad adoption of digital assets and thus do not specifically contemplate the tax treatment of digital assets. For example, despite the importance of staking for the integrity, security, and success of proof-of-stake blockchains, such as Ethereum, important tax issues relating to staking are not adequately addressed by either the tax code or existing sub-regulatory guidance. The tax treatment of these activities and income generated creates novel tax questions that cannot be resolved solely by analogy to existing parts of the code, including how such rewards are sourced, among other questions. In many instances, digital assets face disparate treatment as compared with traditional investment assets, such as securities and commodities, despite the growing role of digital assets in our financial system. The inconsistency in tax treatment under various tax rules results in adverse outcomes for taxpayers and the industry overall. Additionally, modernization of the tax code would support increased compliance and reduce abuse. To support the industry, provisions should be updated to specifically address digital assets. On behalf of Fidelity and the millions of customers we serve, we appreciate the invitation to share our views and contribute to this important dialogue. We applaud congressional efforts to identify and address the gaps in the existing tax framework to support U.S. growth in the digital asset industry, and we look forward to continuing to work with the committee to implement a modernized tax framework for digital assets. I look forward to your questions.
Chairman Schweikert, Ranking Member Sewell, and members of the subcommittee. Thank you for the opportunity to testify today on how the United States can ensure that digital asset policy is built for the 21st century. I am pleased to represent the Crypto Council for Innovation, a global alliance of leaders across the digital asset space. We are active here in the US, as well as in the EU, UK, and Asia Pacific, and represent some of the largest and most prominent companies in the space. I am particularly grateful for the engagement and leadership of so many on this subcommittee. The digital asset sector has evolved significantly over the past decade into a dynamic and expanding ecosystem that now touches payments, capital markets, identity, and data infrastructure. Congress is already advancing foundational legislation to address market structure and stablecoins. While the U.S. has made encouraging strides toward a broader regulatory framework, gaps in tax policy continue to hinder compliance, investment, and enforcement. CCI and I respectfully submit that now is the time to modernize the tax code to reflect the realities of the digital economy. Crypto is more than just a new asset class. The technology on which it is based is the foundational layer for a more open, efficient, and inclusive digital economy. It is also not a monolith. Digital assets are transforming how we transfer value, access financial services, verify digital identity, and much more. While most are familiar with Bitcoin, the digital asset ecosystem has expanded far beyond it. Similar to the way that the internet makes possible apps that enable ride-sharing, e-commerce, and much more, programmable blockchains are powering the next generation of decentralized applications. These systems enable faster, cheaper, and more equitable financial tools that empower individual ownership and control over data and assets. Staking is the engine that powers these blockchains. It's how proof-of-stake networks like Ethereum, Solana, and Avalanche stay secure and functional. While it varies from blockchain to blockchain, these systems rely on token holders who temporarily commit or stake their tokens for the chance to verify transactions and add new blocks to the chain, keeping the network accurate and current across the entire network of globally distributed computers. In return, they are rewarded with new tokens. In January 2019, when I started working on staking policy, the total value staked across proof-of-stake networks was approximately $50 million. Today, over $660 billion is staked across dozens of networks that provide the infrastructure for today's use cases and ones that haven't yet been imagined. Staking is no longer a niche activity. It is the infrastructure layer of the new digital economy. A functioning digital economy requires a functioning tax framework. And right now, when it comes to staking, the process that secures most modern blockchains, we don't have one. Tax policy is not an isolated issue. It is a core pillar of the broader legal infrastructure needed to support digital asset innovation. As Congress considers stablecoin legislation and market structure reform, it is imperative that tax modernization moves in parallel to avoid inconsistencies and ensure that the U.S. is the crypto capital of the world. My written testimony includes greater detail, but in the interest of time, I will highlight 3 key recommendations for the development of a tax framework for digital assets. First, to promote responsible adoption of digital assets for payments, Congress should enact a de minimis exclusion for small personal use digital asset transactions. Second, activities essential to securing and maintaining blockchain networks, like staking and mining, should not be discouraged by overly complex or burdensome tax treatment. Staking and mining rewards should be treated like all other created property. Third, a digital asset-specific safe harbor should be created for foreign investors, similar to those for securities and commodities. Income from staking should qualify as passive income for tax-exempt and publicly traded partnerships, and grantor trust and other ETP structures should be updated to accommodate the staking of digital assets to make our products competitive. The U.S. should want the next generation of internet infrastructure built here, not overseas. But right now, tax uncertainty is one of the biggest reasons developers and firms are looking elsewhere. If we want scalability for stablecoins, decentralized finance, or any of the other applications built on top of proof-of-stake networks, including the ones we haven't yet imagined, we must get the tax policy right. Thank you again for the opportunity to testify before you today. I look forward to your questions.
Chairman Schweikert, Ranking Member Sewell, and members of the subcommittee, thank you for the opportunity to testify today. My name is Jason Somensatto, and I'm the Director of Policy at Coin Center, an independent nonprofit research and advocacy center focused on the public policy issues facing cryptocurrencies. Cryptocurrency networks allow individuals to transfer value directly to others anywhere in the world without relying on a third party. Since the introduction of Bitcoin in 2009, millions of people, including millions of US taxpayers, have used these networks to send peer-to-peer payments and conduct a wide variety of other activity. Yet the tax treatment of these activities is often uncertain, impracticable, and in some cases fundamentally misaligned with well-established principles of tax law. Coin Center has long called for sensible and fair tax policy for cryptocurrencies that recognizes the novel manner in which these assets are created and used. Our goal is not to seek special treatment for cryptocurrency transactions, but rather to ensure they are taxed in a manner consistent with how comparable transactions are treated under the law. This hearing presents an important opportunity to begin addressing the current obstacles to that equal treatment. I will focus my testimony on 3 recommendations. 1, creating a de minimis exception for personal transactions. 2, clarifying that block rewards are only income upon disposition. And 3, repealing the application of Section 6050I to crypto. The IRS treats most cryptocurrencies as property. This means that any sale, exchange, or use of cryptocurrency can trigger a capital gain or loss, no matter how small that transaction. For example, a user who spends a dollar-backed stablecoin to buy a cup of coffee would face a surprisingly complex tax obligation. The user must determine the market value of the stablecoin at both the time it was acquired and the time it was spent, even though any gain or loss is likely to be a fraction of a cent. Moreover, because blockchain transactions typically require users to pay small fees in the native asset of the network, the user must also calculate a capital gain or loss on that fee payment. Imagine if sending an email or text message triggered a tax reporting burden each time. This is the type of tax compliance burden currently imposed on everyday users of these networks. In 1997, Congress recognized a similar problem with foreign currency transactions and created a $200 de minimis exception. Coin Center has long championed a comparable fix for cryptocurrency users, which would exclude gains on personal transactions below a certain dollar threshold. Thank you to Chairman Schweikert and Representative Del Bene for introducing legislation to create that sensible fix in past Congresses. A core element of all cryptocurrency networks is that validators, so-called miners and stakers, are incentivized to support the network by the ability to mint newly created cryptocurrencies for themselves. This mechanism is central to how these networks function without a central authority. Rather than relying on a trusted intermediary, the protocol uses economic incentives to coordinate a decentralized group of participants to verify transactions. The IRS currently treats newly created block rewards as gross income upon receipt, but these tokens are not received from another party. They are created by the validator, like a farmer grows a crop or an author writes a novel. The IRS's mischaracterization of block rewards leads to overtaxation, especially when tokens are depreciate or are offset by dilution. Congress should help ensure that block rewards are treated in line with existing tax principles applicable to newly created property, and clarify that rewards only constitute income upon disposition. We also encourage the executive branch to promptly rescind its earlier guidance on this topic, consistent with the positions in Josh Jarrett's lawsuit that we are supporting in the Sixth Circuit. Finally, the Infrastructure Act passed in 2021 extended Section 6050I reporting to cryptocurrencies. This provision requires anyone receiving over $10,000 in cryptocurrency to report detailed personal information about the sender. An artist receiving cryptocurrency for an NFT sale or a nonprofit receiving an anonymous donation face potential felony charges if they don't provide sensitive identifying information to the government, which in some cases may be impossible to collect. Coin Center has challenged the constitutionality of this provision in federal court, and we urge Congress to repeal or amend it. The promise of cryptocurrency lies in its ability to empower individuals and enable open innovation. But to realize that promise, the tax code must not impose unnecessary or unfair burdens on individual taxpayers. By enacting reasonable reforms, Congress can ensure that users are taxed fairly and participation in these networks remains accessible to ordinary Americans. Thank you.
Ranking Member, Chair, members, thanks for having me here today. My name is Frayer. I am the Director of Investor Protection at Consumer Federation of America. Prior to that, I spent 3 years at the SEC as Chair Gensler's Senior Advisor on crypto issues across the agency. And before that, I spent 15 years in Congress on the Banking Committee, on the House Financial Services Committee, working on financial regulatory issues, including financial technology. And then before that, I was a network architect. And so my entree into distributed computing happened about 10 years before Bitcoin existed in a project called SETI at Home, where you could lend your computing power to help Berkeley try to identify extraterrestrial life. So yeah, a little bit of a nerd. I think one of the things that's, and I actually wanted to say this as well. I also want to thank the staff. I've been on that side of the table. It's a hard job. Taxpayers are lucky to have you at bargain basement prices, especially at a time when we're losing a lot of talent in the federal service. It is great that you are here doing this job. It's really important. Now that I've thanked everyone, I want to apologize in advance because I'm going to use a cliche that I'm sure this committee has heard way too many times. Which is that there are only two certainties in life, death and taxes. I want to add another certainty to that, which is that you should never make predictions about where technology is going to be in 5 or 10 years. I think if you went through this table and asked us all questions about tech, one of us is going to look pretty dumb in 5 years. And that's why we have a set of regulatory laws that prevents regulators from making decisions based on technology. Our financial laws have us look at the economic reality. And that's good because I'm a crypto critic, that's well known. But when I was at the SEC, I was bound by rules to treat all technology fair. That's great. You don't want regulators picking winners and losers. It's important to the markets themselves. You can't treat like assets differently. It harms the markets, it harms price discovery. The markets get to decide who fails and who flourishes. Now, it's important when we're talking about clarity around crypto to be clear about what exactly it is. It is one in a series of many innovations that have happened over the years. The stock market used to rely on kids running wheelbarrows between exchanges and clearinghouses. It's now completely digitized. Commodities future markets used to rely on pits of people yelling at each other across the room, like Trading Places style. That has been almost fully digitized. And checks used to be flown across the country in jets. And now you can tap your phone on a little electric box and it tells a bank to make a digital entry on a digital ledger, and that's how we deal with our money. And so what crypto is really about is this new settlement mechanism. So to the extent that we're going to make crypto policy, we need to focus on the actual difference between crypto and the rest of the financial system, which is narrowly this different way of settling transactions. It's an impressive technology. I was very impressed by it. I think it's really interesting, but it is a very specific and identifiable thing, and we have to keep that in mind while we're thinking about how to do regulatory policy and tax policy with regard to these assets. And there should be some clarifications regarding tax treatment. There should be some narrow clarifications regarding regulation. Now, when you think about that, what that tech is, then you can see that nothing about that tech justifies the business decisions that exist in the crypto asset system right now. Nothing justifies lesser treatment of investors or consumers. Nothing justifies large crypto conglomerates that mix many, many different functions and replace arm's length transactions with conflicts of interest. And there's nothing that would justify different rules for crypto than we have for every other financial asset. And that's not just my opinion. There are a lot of business people. The ICBA agrees with equal treatment of assets. SIFMA has written letters to the SEC about equal treatment. And I want to leave you with a quote from a crypto entrepreneur who also agrees with me. Bradley Garlinghouse, the CEO of Ripple, in 2017 said, "Regulatory uncertainty is just a euphemism for we wish we didn't have to follow SEC regulations."
I appreciate all the witnesses' testimony. Shall we start with the chairman of the committee, Mr. Smith?
Thank you, Chairman, Ranking Member. It's great to be with you all this morning on this topic. Today, digital assets are a rapidly growing market with over 50 million of our fellow citizens invested in some manner of cryptocurrency. Jobs in the digital asset economy expanded by 118% year over year, and the Bitcoin mining industry alone has generated 31,000 jobs. There is clearly an opportunity and interest in encouraging further growth and innovation in this space. Ms. Mersinger, how does the current tax treatment of digital assets affect the industry and its customers, and how might more tax certainty encourage growth and investment in the crypto economy?
Thank you for that question, Chairman. The current tax treatment of digital assets is complex, it's burdensome, and it's costly. And for every dollar that is spent on complying with the tax code, that's one less dollar that is injected back into the business, back into innovation. And the tax code should never be a barrier to innovation. We need to modernize the tax code so we can level the playing field for digital assets, reduce these unnecessary burdens, and unlock the innovation and growth of the industry here in the United States.
Thank you. President Trump has said he wants to make the U.S. the crypto capital of the world. Unfortunately, right now, we risk losing the race for innovation and global leadership on this front to other nations. Ms. Mangiero, are there any lessons that we can learn from other nations that are seeking to secure a more competitive advantage, or perhaps things to avoid? And what will being the crypto capital of the world mean for American businesses, workers, and our broader economy?
Well, thanks for the question, Chairman. I think one thing we should think about is in the early days of the internet, we couldn't imagine all of the various use cases there would be, things like e-commerce, cloud computing, social media, and the associated jobs that would be created, the companies that were built right here in the US. And we created the policy framework, both on the tax and the regulatory side, that enabled those businesses to flourish here in the US. What happened was the rest of the world saw that. They saw that we were the global leader in Web 2, and now they're all competing to be the jurisdiction of choice for crypto and Web 3. So the EU has already established a framework. The UK, which was taking a phased approach, is now, as of January of this year, announced that they are going to do all of their frameworks this year. And Japan, especially, is now enacting tax reforms to make them more competitive on the tax side. What I don't want to see happen here is something like chips, where we used to dominate, we didn't have the right framework, that business left, and now we're spending billions of dollars to lure it back. So I think that's the lesson to be taken away here.
Agreed. Why we're doing this hearing. Congress can help contribute to a healthy digital asset marketplace by ensuring that the laws and regulations are not overly burdensome for businesses, consumers, and taxpayers. For example, earlier this year, Congress, led by this committee, approved a resolution signed into law by President Trump that overturned a Biden administration rule seeking to regulate decentralized finance, or DeFi, brokers by imposing unworkable reporting requirements on taxpayers and small businesses, threatening to cripple the digital asset industry in the process. Mr. Somensatto, I would prefer to call you Jason because it's such a great name. But aside from a need for more structure and certainty within the tax code, what are other regulatory hurdles or potential speed bumps that you see that exist today or could exist in the future that deserves this committee's attention?
Thanks for the question. I think, as I highlighted in my testimony, probably the primary hurdle for individual users, which is where we focus our attention at Coin Center, is on the taxation of very small transactions that are inherent in these networks. And so, as a kind of first order, we have long promoted the idea of a de minimis exception. I think on the regulatory front, your reference to the broker rule brings up an issue that has been at the heart of the regulatory discussion for quite some time, which is how do you differentiate between trusted institutions that play typical business roles in this community, which should have obligations, for example, on tax reporting, and identifying where we run into developers just creating software that anybody could use, and ensuring that we're not placing tax obligations on those developers. And that's kind of an important element of some of the bills that are going through on the regulatory side right now.
Thank you. I'm reminded of words that President Reagan gave when he was talking about just the functions of government. And I think it resonates today with this industry, this hearing. But Reagan always viewed that government would tax anything that's moving. And if it continued to move, they would regulate it. And if it stopped moving, they would then subsidize it. We need to learn from those mistakes and make sure we create an industry that thrives. And that's what we're looking to do. Thank you, Mr. Chairman.
Thank you, Mr. Chairman. Ms. Sewell.
First, before I begin, I want to have this article from Reuters entitled "Crypto Exchanges Rushed to List Trump's Coin, Leaving Many Losers and Some Big Winners." Can I please submit that for the record? Mr. Frayer, is it normal to have in one day a coin listed? I mean, I know that you know the regulatory process, but I think that in one day to have our president's coin listed was pretty fast.
It is genuinely unusual. Kraken was the first to list the coin. I think the president announced it at 9:30, and by 1:30 the next day, they had it trading on Kraken. And I think even Coinbase acknowledged that it was not normal under their process to list it so quickly, and it wasn't something they may have listed, but they said essentially the demand was high.
Just for the record, wouldn't it be great if we had ethical rules that limited politicians who have power to sign laws, make laws, limit their ability to do that while they're in office.
I think that's really important just for faith and democracy and fairness' sake.
Yes. You know, I started by talking about my Alabama district. My Alabama district is a civil rights district, so it's historic cities like Birmingham and Tuscaloosa and Selma. But it also includes a lot of the rural communities of the Black Belt, where people are unbanked or underbanked. And so for far too long, the families in my district have had limited access to capital, full stop. And as we explore this stable coins and digital assets, I know it has both promise and perils. I just really think it's really important that we think about the accountability. You know, innovation without accountability, I believe, is no blessing. And the folks who tend to be most hurt by that are those that are not financially savvy. So it's really important that we get this right. So I wanted to talk to you about the Genius Act. Do you think that the Genius Act, is it the best we can do in terms of regulatory? And if not, what do you think the biggest peril is?
No, I really don't think it is. I think essentially what the bill does is make it easier for non-bank stablecoin companies to get access to the Fed master accounts. They promised a different infrastructure for doing payments, and now they want access to the public infrastructure that we already use. And so I think they should compete on a level playing field with banks. And so when you take that kind of activity out of well-regulated banks, it puts the economy at risk, and ultimately it's taxpayers that have to bail it out.
Thanks. In terms of the IRS, do we currently have the tools and the manpower that we need to actually regulate or to collect taxes on these kinds of transactions? And I know that the settlement is really, really important, and want to know your thoughts about how we can do that better.
I'm not a tax expert. What I will say, my understanding is that the IRS is not well staffed. And I think that makes it a real challenge to deal with new issues in a marketplace that moves quickly and where anonymity or pseudonymity is a big issue.
Yeah.
So yeah, those are challenges.
Ms. Reilly, I know that you are a tax expert. Can you talk to us about the crypto industry and the type of tax regulations that would help protect consumers?
Sure. Thank you for the question, Congresswoman. As at Fidelity, we are very concerned with protecting our investors, particularly kind of your everyday retail investors. I think one of the issues right now is the lack of certainty and consistency. I think that makes following compliance very challenging for everyday investors. They also may struggle to understand the tax consequences of holding digital assets, and I think that hurts both the industry, but it does hurt your everyday investor. And I think, for example, exchange-traded products are how many retail investors may have exposure to digital assets because they can hold them through their individual retirement accounts. They can hold them in their brokerage account. There currently are some, challenges and complexities in those rules in terms of giving those investors full exposure to the value of those assets.
I want to yield back,
Sure.
reclaim my time if you don't.
Oh,
We only
sure.
have 30 seconds. I have 30 seconds. And I really want to just go on the record as saying that financial innovation is critically important. I remember in the 90s when we had derivatives and people didn't understand derivatives. And we rushed, I thought, to actually passing laws and regulations that had unintended consequences, if you will. And so while I am absolutely convinced that we as Americans should lead in this industry, and I do know that the Europeans and other global countries are right behind us, but I think that it's important that we don't sacrifice accountability in the guise of financial innovation. And I, as a lawyer in New York, used to do derivatives, and people didn't understand it at all. And we had to ultimately correct stuff through the Dodd-Frank legislation. I say all that to say, Mr. Chairman, we have a big task ahead of us, not only for the regulatory framework, but also for the tax framework.
And it's one of the reasons I'm elated to have you as the ranker. Ms. Fishbach.
I feel very short when I can't reach the button down there. But thank you, Mr. Chair, and thank you all for being here. I appreciate this. It's a fascinating topic, and so I appreciate all of the expertise that you provide. And I was going to ask Ms. Mersinger, but follow up from, and forgive me, I am worse at pronouncing names than he is. So Ms. Mangiero and Mr. Somensatto. Oh, God.
Somensatto.
Oh, there you go. Okay, or maybe I'll just call you
it's not
Jason.
like it's an easy
Maybe I'll just
name.
call you Jason too. But I just wanted to discuss some of the taxable activities that are unique to digital assets, and some of the folks talked about staking, and I believe someone mentioned mining. And individuals or companies that engage in mining or staking often receive some form of income as a reward for their contribution to the network. And I know it depends on the specific blockchain, but generally mining and staking rewards come in two forms, either newly minted assets or transaction fees. So how should we think about the rewards received from mining or staking from a tax perspective? I know that Jason, forgive me for that's awful. I should be more formal. But you had mentioned property at some point. Mentioned creating or new property, and so I'm just kind of wondering how do we get our heads around dealing with those as a taxable thing?
Yeah, and no worries on calling me by my first name. My father might be a little disappointed watching, but he'll be all right.
We'll say hi to him.
Yeah, exactly. So you're right in terms of supporting all of these networks. There are generally what are called validators, right? They might be miners, they might be stakers, but they play some role in terms of validating transactions and getting rewarded for that work. The block rewards issue that I mentioned comes specifically from that ability to, when you are successful in validating these transactions, the rules of the network allow those validators to create new currencies for themselves. And so our position is like, that is not income at the time that it's received. It is kind of created property, as I was mentioning. And that becomes really important, particularly because there is also like inflation rates with these networks, right, where they create new tokens. So it's not just that like, oh, you get new tokens and you automatically get value. It might be, nominally that looks like it, but there might be a difference in the actual amount of value you receive based on the inflation rate broadly of the network. The other thing you mentioned was transaction fees, which on some networks do go to these validators as well. I think from a simplicity perspective, like it should also be treated the same as this kind of newly created property, because it's very difficult to kind of identify where the fees are coming in, where they're going out to one particular validator or center of a transaction.
Thank you very much, and I'd like to give Ms. Mersinger and Ms. Mangiero an opportunity to respond. I've got 2 minutes, so if you each want a minute, please.
Yeah, sure. So thank you so much for the question, Congresswoman. The one thing I would add there is there's also an issue if you don't treat these things like created property and you treat them as ordinary income at the time of receipt. In terms of actual administrability, this could mean that a taxpayer could have a taxable event every day, or according to some blockchains, every 6 seconds. That's a nightmare. And so the issue is one of overtaxation, as Jason mentioned. It's also an issue of dilution. As you can imagine, as these new tokens are created, the overall amount of tokens in the network goes up. And so if you are not receiving the appropriate share, your stake in the network overall is actually diluted. So you have a problem with overtaxation, you have a problem with dilution, and we have a real problem in terms of actually administering the tax policy on behalf of both the taxpayer and the IRS.
Thank you, and Ms. Mersinger.
I'll try to do this really quick. I like to look at simple kind of demonstrations. My dad is a farmer in South Dakota. He grows wheat, sunflower, corn. And the idea of taxing these rewards upon receipt, in my mind, is much like, and Jason said this, taxing the farmer for their crops before they sell them. They wouldn't have the money to pay that tax until they sell their crops. So taxing it at the point of the crop coming out of the ground or the crop being harvested just doesn't work. And it's the same idea here. The reward is not a taxable event. It is a creation of property for the individual validator.
So just so once they totally dispose of and sell it, like I'm selling I'm going to the elevator and I'm selling that corn. But so once they totally dispose of it, so all of those transactions, all that they're doing, and I know I'm out of time, but all that they're doing just gets to happen until they're done. So thank you very much.
Thank you, Mr. Chairman.
Mr. Frayer,
When looking to uncover corruption, it's often said to follow the money. So let's do that in the case of World Liberty Financial, the crypto platform that Donald Trump and his family's corporate entity largely own and profit from. On January 19th, 2025, the day before Trump's inauguration, billionaire Justin Sun announced he would be investing an additional $45 million into World Liberty, and World Liberty's coins, in fact, on top of the $30 million he invested the previous November, bringing his total investment into the coin to a whopping $75 million. But Justin Sun is no regular investor. He was sued by the SEC under the Biden administration for selling unregistered crypto assets, fraudulently manipulating the markets for his own gain, and paying celebrities to promote his illegally inflated crypto coins without disclosing their payments. Just about a month after Mr. Sun's January announcement that he would be pouring even more funds into World Liberty, Trump's SEC paused the case against him. Still, Mr. Sun has maintained that his investment was merely an indication of support for Trump and his family's excellent project. So, Mr. Frayer, do you think Mr. Sun's investment in World Liberty is actually a vote of confidence for Trump's excellent product? Or how concerned should we be about the safety of the crypto market when Trump's World Liberty opens the doors for bad actors to buy their way into the president's good graces?
I mean, I think it's just one of many transactions that demonstrates that there's a pay-to-play game with regard to crypto enforcement in this country. In President Trump's first term, he said Bitcoin was a scam. He appointed Jay Clayton, who was a tough regulator on crypto, just like Gary was. And after he started a crypto company, he changed his tune, all that. So his business associates, we just learned a couple weeks ago that Binance helped him create the World Liberty Financial stablecoin. They get special treatment. He did a $2 billion transaction with the national security advisors of the UAE's VC firm, and they bought $2 billion of Trump's stablecoin in order to invest it in Binance. There's no reason to do that kind of transaction unless you want to buy influence with the president.
Thank you for that. And I want to again follow the money. In February of this year, Eric Trump tweeted that it was a great time for people to add the cryptocurrency Ether to their wallets. He added, "You can thank me later," but then deleted it. Just 1 month later, Donald Trump announced the creation of the U.S. Crypto Strategic Reserve, an official federal stockpile of digital assets for the U.S. government to purchase and hold. The president proudly proclaimed that Ether would be at the very heart of this reserve. So it's no surprise that directly after this announcement, Ether's price skyrocketed by 13%. But guess who else benefited from Trump's Ether announcement? To no one's surprise, it was Trump and his family. That's because over the months preceding the stockpile announcement, his World Liberty Financial had invested nearly $250 million into Ether. So on the day of the announcement, World Liberty's Ether stash was boosted by $33 million. It is perfectly clear that Donald Trump is manipulating U.S. policy to line his own pockets. So, Mr. Frayer, what risks do these flagrant conflicts of interest pose to the cryptocurrency market and the American consumers who participate in it?
Well, first of all, if I were in the crypto industry running a company, I would be shouting about making sure the president wasn't manipulating the markets and making them look quite bad, honestly. I think there was a Pew poll in the end of last year. It said 63% of Americans don't trust crypto, and 81% of Americans who have experience with crypto don't trust crypto. So I think when you have this issue where clearly an elected official is manipulating the markets and benefiting from that, it has to create a lack of confidence in that industry. So I think it's really harmful.
Yeah. Now, President Biden established the National Cryptocurrency Enforcement Team within the Justice Department, but Trump just disbanded this task force. What is why is it important to have these kind of checks?
It's important because people use financial instruments all the time to influence the government, and so you want to sort that kind of thing out. We have anti-bribery laws that need to be enforced. And in fact, the SEC had a large team working on crypto asset laws and enforcement, and that team has been renamed and essentially reassigned. And the top litigator on crypto issues was reassigned to the IT department to work on computers as a political punishment for having done his job. So taking away this enforcement is really damaging to not just the crypto markets, but to compliance in all of the markets.
Thank you. I yield back.
Thank you, Ms. Shu. To my monster drinking friend.
Thank you, Chairman.
You know, that stuff's horrible. Why can't you just do coffee like that?
By the way, it's not carbonated, and I don't think Secretary Kennedy would approve, but, you know, a United States Marine, we live off this, and in Congress, it still goes.
All right.
So. Thank you, Mr. Chairman, and thank you to our witnesses for your time and testimony here today. I'm pleased that this committee is addressing the very important issue of digital asset tax policy and what we need to do to make it America the crypto capital of the world. In recent years, Congress has made meaningful progress on market structure and stablecoin legislation. Bills like the Genius Act and the Digital Asset Market Clarity Act will help clearly define the roles of the SEC and CFTC, establish rules for digital asset trading platforms, protect consumers, and promote blockchain innovation right here within the United States. However, the tax code has seriously lagged behind. Our laws were written for the traditional analog economy. It's time to bring them into the digital era. That's why I'm proud to be leading efforts on a comprehensive tax framework for digital assets, one that will provide a long overdue clarity for consumers, innovators, and investors alike. In the coming weeks, I plan to release draft legislative text developed in collaboration with my colleagues and stakeholders across the ecosystem. I hope this legislation will ease the reporting burden for de minimis transactions, modernize wash sale rules, and mark-to-market elections for traders and institutions, provide clear guidance on staking, mining, and income recognition, and improve the treatment of charitable contributions, lending, and qualified retirement plans. In short, we need parity and clarity. We need a tax code that keeps up with innovation and not one that chases it overseas. Providing the certainty won't just improve compliance, it will unlock investment, create jobs, and expand access to next-generation financial infrastructure. We must get this right, not only for innovation's sake, but for the American leadership in financial technology. I call on my colleagues on this committee to join me in this effort on behalf of the millions of Americans investing in these assets of tomorrow, today. Ms. Mangiero, we've seen crypto-related job postings increase by over 100% year over year, with projections showing continued acceleration through 2025. In your view, how would implementing a comprehensive tax framework impact hiring, capital formation, and long-term domestic investment within this space? Would certainty around issues like staking, mark-to-market, and de minimis thresholds help drive growth?
Thanks for the question, Congressman, and thanks for your leadership in this space. What I would say is particularly focused on the staking issue. Staking is a homegrown American industry. Bison Trails, which was one of the first staking-as-a-service providers, headquartered in New York City, eventually acquired by Coinbase, became Coinbase Cloud, now runs the enterprise staking infrastructure that powers a lot of this industry, has created hundreds of jobs. Blockdaemon, another company in this space, US-based company, unicorn status, $3.25 billion, all of the job growth created with that. So I think what we're seeing is, especially with regard to the staking industry, this is an industry that was born here. As I said previously in my remarks, when I first started working on this in 2019, $50 million today, $660 billion industry. I think you can see how important it is for us to keep that here in the U.S.
Yeah, I could not agree more with what you had just said, and thank you for that. Ms. Reilly, legislative activity across several committees, from market structure and financial services to stablecoins and banking, has been strong. Tax policy is the through line connecting it all. Can you speak to how updated tax guidance would complement or even accelerate progress on market structure, consumer protection, and custody of frameworks across Congress? And if I may, what is the cost of continued inaction on the tax side?
Thank you, Congressman, for the question. I think that's a great point that as other regulatory efforts are moving forward, without having a tax code that keeps up, it could hinder the adoption and success of these efforts. I think a good example is in the context of stablecoin. There is still some work to be done in terms of broker reporting, especially if you're imagining the use case of stablecoins being used as payment stablecoins. If you want there to be widespread adoption, there needs to be a complementary tax code revisions as well. And I think tax certainty is an important part of market adoption. Taxpayers, when they lack confidence, it's difficult to develop new products, to innovate. And I think it could be a real hindrance as we move forward in these other efforts if the code does not keep up.
Thank you for that. Thank you, Mr. Chairman, and thank you to our witnesses. I yield back.
Thank you, Mr. Chairman. Thanks to all of our witnesses for being here. We appreciate it. I think it's critically important that we work to modernize infrastructure, and that includes our financial infrastructure. And crypto, blockchain, digital assets are part of that. Innovations can lower fees and transaction times, increase consumers' financial privacy and security, and help unbanked communities. But right now, the crypto industry is facing a crisis of confidence, trust issue with the American people. And I hope this panel can provide some answers so folks can gain back that trust. 3 days before taking office, President Trump released a meme coin to the public and promoted a private dinner for the top 220 coin holders and a special VIP White House tour for the top 25. That's corruption. The president is opening the White House up for business and selling the fate of the American people to the highest bidder. We also know one of the top buyers of the coin was a China-linked firm called the GD Culture Group. Despite reporting zero revenue in 2024, this company somehow managed to purchase hundreds of millions of dollars of Trump's meme coin using proceeds from a, quote, a stock sale to an unnamed entity in the British Virgin Islands, unquote. That's not putting America first. I worry that this conflict of interest will harm our national security. But again, how can people have trust? Since taking office, the president has netted over $350 million through the token sales and fees. At the same time, it's cost more than 800,000 people over $2 billion. This behavior understandably erodes people's trust in the industry. This week, there were supposed to be this week, we'll look at multiple crypto bills coming to the floor. And I think it's important that we have the necessary regulatory safeguards and robust resources to protect consumers from fraud. So, Mr. Frayer, do any of the provisions, as we look at the bills coming forward, criminalize future presidents who use cryptocurrency to engage in influence peddling or perpetuate crypto-related scams?
There are no provisions like that that I know of.
These bills significantly expand the role of the CFTC in supervising digital assets. Do either the Clarity Act or the Genius Act provide additional resources to the CFTC so it can fulfill its new role to supervise this market and enforce new rules?
Absolutely not, and neither regulator is well funded enough to do this job.
And in your testimony, you talk about the need for technology-neutral regulations to ensure federal regulators cannot pick winners and losers or accidentally create confusion and price dislocations in the marketplace. Could you provide more details about why it's important that Congress regulate the crypto industry using technology-neutral language and the dangers if we fail to do so?
Well, first of all, the reason you use technology-neutral analysis is just out of fairness. You want technology to win on its merits, not out of any favors through regulation or policy. The second reason is, like you said, you don't want them picking winners and losers. They don't know the future. And so you want to make sure you're making policy that is durable through other kinds of new technology. Digital assets came very quickly. Who knows that there might be another development really soon. That makes it important that we sort of include that kind of regulation to cover whatever this new technology is. If we tailor this all to crypto assets in this particular technology, we're going to miss out on that opportunity to get it right.
And I think, obviously, when we're working with anything new, and as we have new innovation in all sorts of sectors, we see changes. We need to put policy in place, but we need to keep policy up to date based on what we learn, which is also critically important. And that means making sure that we have robust funding and the resources to protect consumers. And given what we've seen happen to federal agencies, we can talk about the bills and what the right language is in the bills, which is very, very important. But it's also important that we have folks who are able to make sure that those rules are being followed. Without resources, whatever we put in the bill may not matter if we aren't making sure that those rules are being followed and make sure that we have robust consumer protections. Is that correct?
That's absolutely right.
No. Thank you so much. I yield back, Mr. Chairman.
Thank you very much, Mr. Chairman, and thank you to our witnesses who are here today. Digital assets are transforming the way Americans invest, they transact and think about money. Today, more than 50 million Americans hold some form of cryptocurrency, making the United States one of the largest digital asset markets in the world by both user base and investment size. And nowhere is that momentum more apparent than in Texas. Our state has quickly become a hub for digital asset innovation, attracting investment, talent, and cutting-edge technologies from across the country. And despite this remarkable growth, the Internal Revenue Code still lacks a clear and comprehensive framework for how we tax digital assets. And as a result, consumers, innovators, and investors are left navigating a patchwork of rules that don't really reflect the realities of these emerging technologies. So from the taxation of mining and stocking to reporting requirements, fundamental questions remain unanswered about the character, the source, and the timing. Digital assets are more than just speculative investments. They're used as payment methods, as access tools for new online services, and as vehicles for exchange that bypass traditional intermediaries. For many, this technology offers a new way to store value, preserve privacy, and participate in a decentralized financial system, one not reliant on large institutions or central governments. So with all this in mind, unless Congress provides clarity in the tax code, we risk pushing this entire ecosystem overseas. So countries like Switzerland and Singapore are already establishing themselves as digital-friendly jurisdictions, and if we fail to act, we hand them our future of financial innovation. So President Trump has made it very clear that America must lead in this space, and advancing a smart, modern tax framework is a critical step to realizing the vision and keeping the digital asset economy and the jobs that it creates here at home. So this committee just delivered a resounding win for the American consumer, for the worker, and for businesses through this one big, beautiful bill, but our work that is reigniting the engine of the American economy is not yet over. Ms. Mersinger, can you please speak to the potential risks if Congress is not able to provide a comprehensive tax framework for the treatment of digital assets?
Thank you for that question. And you hit on one of the main risks, which is losing the jobs and capital and innovation to jurisdictions overseas. I think the other concern here is that we risk a slow adoption of digital assets here in the U.S. If you think about the need for a de minimis exemption, if every transaction in digital assets is taxed, it's going to be really difficult for that consumer, that individual, to use cryptocurrency as a medium for everyday economic activity. I think you also you're going to burden the taxpayer with these unworkable compliance requirements. And so it really is, there's a number of risks involved. And so we have to we have to modernize the tax code so that we have some fairness, so that we're lowering the burdens, and we can allow the U.S. to be the crypto capital of the world.
I appreciate that answer. Ms. Reilly, the SEC recently approved exchange-traded products, or ETPs, for digital assets such as Bitcoin and Ethereum, and is currently considering expanding that approval to allow for staking of digital assets that use a proof of stake consensus mechanism. What is the current tax treatment of ETPs, and why do staking and similar activities present challenges under the existing rules?
Thank you for the question, Congresswoman. I do just want to highlight that ETPs essentially democratize the availability of digital assets. This is how many retail investors can access them. Most of them are structured either as grant or trusts, which is a tax construct, or partnerships. Grantor trusts allow the tax treatment to be consistent as though the holder holds the digital assets directly, which provides simplification and efficiency for those individuals, but without needing the know-how to set up their own wallet. They can access this through traditional brokerage. They can hold this in their IRA. So it provides simplicity there while giving them the same consistent tax treatment as holding it directly. The grantor trust rules are old. They well predate the onset of digital assets. And they don't contemplate something as novel as staking. And many in the industry are working to try and get comfortable in an area that legislative clarity could provide consistency in the market. I realize I'm at time, but just to wrap up, that it also is in the spirit of the grantor trust rules as well. Thank you.
Thank you. I'm out of time too. So, thank you very much, Mr. Chairman.
Thank you very much, Mr. Chairman, and to each of our witnesses. I certainly have a number of neighbors in Austin that are interested in crypto and its future. I'll have to say, if crypto has a big future, President Trump is certainly giving it a bad name with the way he has used his office to enrich himself and his family by billions of dollars. One of the concerns that I've always had when I hear about new tax changes that must occur, and like the Genius Act, our Republican colleagues are masters at naming bills. It's just what's inside them that creates a problem. And that's been true of their big, beautiful bill. And I think it is also true, Mr. Frayer, about a piece of legislation just introduced last week called dealing with staking, the proof of stake. And New York University's Tax Law Center, an independent group, has said that this amounts to a tax subsidy for digital assets. Can you comment about that, and generally this idea that we need some new special preferential tax treatment, some new loophole that the loophole masters over here are great at creating, specifically for some parts of digital assets?
Yeah, absolutely. So one myth I want to dispel, that staking is done by small people out of the garage. To stake ETH, for example, you need more than $60,000 worth of ETH in order to run your own validator. So what this is large companies who run these validators and are generally the people we're talking about when we talk about taxation. The other space for staking is staking as a service, where people combine all of their assets and stake that way. Someone offers that service and then distributes those gains. And we have, that's a pretty regular securities arrangement, and we have rules for that. The other thing I'd like to mention really briefly is that stakers and miners in Texas, when they run up those mining machines, prices for energy in Texas go up for regular consumers. So you're paying for crypto whether you like it or not. That's not great consumer choice.
And as far as investors who put their money in crypto funds that aren't registered with the SEC, isn't it true that investors today can put their money into crypto funds that are registered with the SEC, that are fully compliant with SEC regulations without our having to change any law?
Not only can they do that, there are many companies that offer products on the blockchain with full compliance with the securities laws.
And, Mr. Chairman, I would ask unanimous consent to add into our record a letter from the Independent Bankers Association of Texas expressing concern and great opposition to what they call the race to the bottom provisions of the Genius Act, Section 16D, which, among other things, they say will really interfere with state authority over banking. Let me add that to the record at this time with your consent. Mr. Chairman? Yeah, just asking unanimous consent to add that into the record. Okay, thank you. And let's go back then to some of what Ms. Delbeni referred to with reference to the corruption associated with this. You, in your written testimony, by saying crises are avoidable, and my question to you centers on whether we aren't risking, because of the way the President has operated and the legislation that's being advanced, another crisis of the type that we had in back about 15 years ago, where we not only have great loss that affects the rest of our economy, but we will be seeing that the taxpayers are once again asked to bail out wealthy investors.
Great question. One thing I want to say is that crypto is a very small part of our markets. It's $120 trillion securities markets. Crypto's, about 3% of that if you count the commodities, which is $3 trillion of the crypto assets. And American leadership in the financial markets is not going to survive if we bend the rules and put at risk that $120 trillion leadership, that dollar dominance, because everybody trusts our markets. If we bend that to allow crypto to have special favors and put the rest of the market at risk.
How would adopting special exemptions for crypto benefit President Trump and his family?
As an owner of crypto companies, he is supposed to be bound by those laws. If he weakens those laws, if he chooses regulators that won't enforce the laws, then he can make money doing illicit activity and being influenced by foreign governments, and no one's going to be able to keep track of it.
And we know, as was pointed out earlier, that the SEC just happened to drop its investigation of a Chinese businessman who'd invested $75 million and has apparently also dropped its lawsuit against Binance and its founder, CZ. Isn't that correct?
That is correct.
All of this happening just about the time that they're doing things to help the Trump family.
Direct business partnerships.
Thank you very much.
Thank you, Mr. Doggett. As committee practice, we're going to go to 2-to-1 just to balance things up. Mr. B.
There's one for the committee.
Thank you very much, Mr. Chairman. Good morning to you, and good morning, Ways and Means Committee. Happy Crypto Week. We're glad to have you here, panelists. You'll always get to say that time I testified before Congress. I'm a Doge guy, not so much the coin, but the mission to eliminate waste, fraud, and abuse. I read last night something that jumped out at me. It's the way we're going to be handling sales of crypto. And starting this year, taxpayers involved in the sale of qualifying stablecoins or specified non-fungible tokens will be required to complete a 1099 DA form, putting crypto exchanges under the microscope like never before. And here's where it gets dicey for the government to regulate this market. This reporting requirement is estimated to result in the processing of 8 billion new 1099 tax forms each year, requiring the IRS to use 4 billion hours of labor to process the form. Estimates range as high as 250 billion to regulate this new sector. Ms. Mersinger, is that the best way to go forward? Is that efficient? What say you, Ms. Mersinger?
Thank you for the question. It's not the most efficient way to go forward. It is a burden on the consumer. It's going to be a burden on the IRS. And for every dollar spent on tax compliance, that's one less dollar that can be invested in the company and
So you say it's not the best way. What best way is there? What's a better way to go forward?
For example, we could have a de minimis exemption, a set amount where if your transaction is under that amount, then you do not need to have a 1099 and report it. That exists in other areas of the tax code, and it certainly would be helpful here.
10-4. Ms. Reilly, is she correct? Ms. Mersinger just gave us that answer. What would you agree or disagree?
I think that a de minimis exemption, thank you for the question, Congressman, that does address some of the issue, but with stable coins in general, I think there's a question about whether it should be maybe carved out from broker reporting entirely, regardless of how much is in the transaction, given that the potential for gain or loss is minimal. And so the benefit of this reporting—
You would say yes. You say yes. She nailed it.
Oh, yeah.
Ms. Mangiero is nodding. She says yes, too. Mr. Somensatto, you talked about buying a cup of coffee with Bitcoin or something and the nightmare of recording the transaction. Should there be a de minimis for transactions? Would you agree with that?
Yes, and Coin Center has long advocated for that and worked with some members.
What should it be? What's the number?
Well, I mean, again, as we said earlier, like, I don't think cryptocurrency deserves some special treatment for, under the tax code. And so looking to comparable exemptions makes sense. The foreign currency transaction, I believe, is $200. I've seen proposals that have it slightly higher or tagged to inflation that makes sense.
10-4. Ms. Mangiero, you give a great example of how the United States really got lost in the chips, computer chips market, and you've given the warning, I guess, that we're falling behind. And I looked it up, and sure enough, the largest crypto exchange is located outside the United States. 3/4 of all cryptocurrencies are off the United States. Should we be worried that we're falling behind?
We should both be worried that we're falling behind, but also cognizant of the fact that these other jurisdictions are now looking at us to see what we're going to do next. So I think we have a small window here where it's incredibly important for us to get this right. Because
is there a country that we should emulate, or is it United States has to flex and go our own way?
I think that we can learn things from the other regulators that are moving in these places. What I would want to say, and it's been said before, we want to make sure that we don't have rules that are too prescriptive, that lock us into the technology in this place and time. So I would say principles-based, forward-looking, and like the UK, we should aim to move quickly.
Very good. What's the big trap? What's the thing that we should be, I mean, it's a totally new market. What should we be worried about? What should be our biggest fear? What's your biggest fear about venturing out?
What keeps me up at night would be to lose the leadership in this space, because I know this technology has such potential. And so I think, again, we're at a critical moment, and while folks are very rightly focused on the regulatory side, a workable tax framework is what's really going to make the difference and ensure that we can keep this industry here.
Thank you very much. Panelists, thank you so much. Mr. Chairman, yield back.
Thank you, Mr. Bean. Ms. Moran.
Thank you, Mr. Chairman, and thank you to our witnesses here today to talk about this very, very important topic about our digital assets and the importance really of bringing clarity to this industry. While the digital asset industry has grown substantially over this past decade, much of the industry is unexplored by many parts of our nation for various reasons, as you guys know. Although many have begun to embrace the new technology, it is critical in my mind that we work to break the barriers that are here in Congress and the uncertainty that's out in the industry to make it more accessible and, frankly, again, to bring certainty to the industry with respect to taxation laws as it relates to our subcommittee responsibilities. Two ways I think we can improve accessibility is to bring that predictability to the market and do a better job, really, of explaining just how broad the use cases are for technologies so that folks do not fear it. I want to focus on the idea of staking today. Those are going to be my questions. It's been brought up a couple of times here. I think congressional action is needed to increase clarity for the taxpayer out there. Staking allows users, as you guys have described, to hold and preserve those assets for a certain period of time in a designated wallet in an effort to earn rewards and validate transaction. It's a vast and growing segment of the digital economy and a win-win method of participating in the digital currency for users, and frankly, it keeps out fraudulent users, as many of you have said. Ms. Reilly, you said in your opening statement, quote, despite the importance of staking, the code has not been updated to address staking, and existing sub-regulatory guidance is insufficient to address all of the important tax issues implicated by staking. Ms. Mangiero, by your testimony, I take it you agree with that. Is that true?
That's true.
How should staking activity be addressed in the tax code, in your opinion? And then, Ms. Reilly, I'll come to you for that question.
Thank you for the question, Congressman. I think the biggest issue is sourcing at this time, particularly if we're looking to keep more business onshore. As of right now, there's no guidance on how staking is sourced, which is requiring advisors to look at things like where are the servers, where are the people working on them. These are easily manipulatable factors. By providing clarity such as sourcing to the recipient, it would put U.S. staking providers on the same level as non-U.S. staking providers in that there wouldn't be any difference in like withholding for foreign investors.
Ms. Mangiero, aside from the idea of sourcing, the idea of timing seems also to be very important too. When should staking activities be taxed? Should they be taxed, as Mr. Somensatto said, about the analogy of growing crops as a farmer does, or when it's sold at the end of the production?
Thank you. I would agree with what Mr. Somensatto said. I think that these staking rewards should be taxed at the time of sale or disposition, not at the time of creation. People have used crops as an example. Sometimes I use other ones like when you write a book, you're not taxed when you finish it, right? You're taxed when you sell it. When you bake a loaf of bread, you're not taxed when it comes out of the oven. You're taxed when you sell it. Same idea here. We want this to be subject to the same tax treatment as all newly created property.
And as I understand it right now, as it works, the validator puts in this stake into a transaction, and then they may get a reward at the end as they grow this crop. But if the transaction is validated, but if it's not, they could actually lose it. They could see some of that reward slashed. I think that's the term that's used. And so at that point, though, if they have grown it, if a transaction's been validated and they've received a stake as a result of putting their initial digital asset in, they're taxed at the ordinary income at that point. And then later when they sell it, they're taxed again at a capital gains rate. Is that currently how that transaction is formed?
That's correct. There's a carrot and a stick, right? So when you stake your tokens, you lock them in order to validate these transactions. If you act honestly, you're rewarded with new tokens. If you validate a transaction that's inaccurate, or most often this happens because validators go offline, then you're what's called slash, and that would result in the loss of tokens. Slashing is very rare, but it does incentivize good behavior.
So Ms. Reilly identified the need for us to bring clarity on sourcing. We've talked about timing. Ms. Mangiero, Mr. Somensatto, you mentioned also the idea of de minimis. I want to ask, in the area of staking, do we need a de minimis exception, or should we not even worry about that in this particular part of the digital asset world?
I think we need a de minimis exception. I don't think it needs to be specifically applicable to staking. I think what's relevant here is that the individual users who are sending transactions, which the stakers are validating, a lot of times you have to also pay a very small fee that can be like a fraction of a cent. And that's where I think a de minimis exception would be extremely important, because I can just tell you from personal experience, you rack up a lot of those transactions. Just like I said, every time you send a payment, you're going to be paying a small native fee to those stakers, and simplifying that process for the individual users is really important.
Yeah, very complicated area here, but we've got to bring certainty so that America leads with innovation and investment. We want to be that leader. We want to see it not just go from 50 million since 2019 to 600 billion, but we want to see it grow even more. We want the transactions here domestically rather than internationally. I appreciate each one of you and your testimony today, and I yield back.
Thank you, Mr. Moran. Mr. Meyer, and you've been actually taking some classes, haven't you?
Yes, but I don't do any crypto mining yet.
Okay, but let me know when you're there. You know, I hear it's all the rage now.
Right. Well, Mr. Chairman, Ranking Member, thank you very much for holding this. Thank you for being here. I've learned a lot already, and your testimonies are very helpful. In May, an investment fund backed by the government of Abu Dhabi made a $2 billion investment using Donald Trump's stablecoin. And these $2 billion flowed to Trump, his family, and their investment partners. They're free to turn around and generate interest and other revenue, making it effectively an interest-free loan from a foreign government. In case corruption wasn't clear enough, the investment was announced by Zach Witkoff, a partner in Trump's crypto ventures and the son of Steve Witkoff, the White House's envoy to the Middle East. This is a system designed to let foreign governments funnel billions of dollars directly to the president as easily and as quickly as possible. This is corrupt, it's illegal, and Mr. Frayer, you said that crypto markets shouldn't receive special carve-outs from regulations, which I agree. Going a step further, do you think that the Constitution's emolument clause should have an exception that lets the president accept a $2 billion gift as long as it's delivered through blockchain?
I think if the framers wanted an exception, they would have put it in there.
Thank you. While hundreds of thousands of investors lost savings on his meme coin, President Trump found another way to make a quick buck. He held a pay-for-access dinner with the top holders of the worthless token and raked in an extra $148 million from the would-be guests. One of those individuals is Justin Sun, a billionaire who bought $20 million of Trump's meme coin, who had 3 crypto companies with fraud cases pending in front of the SEC, all dropped when the Trump administration came into office. The White House is quietly rewarding top investors with corrupt bargains and dropped lawsuits. Mr. Frayer, you warned about the dangers of applying regulations differently to the crypto industry than to other financial markets. Do you believe that applying the law differently to individuals depends on whether they've invested in a specific meme coin is the path to a stable and a healthy financial system?
No, I don't think it is at all. I'd like someone to explain why investors and consumers in crypto deserve fewer protections than they do in the rest of the marketplace.
That is one of the reasons why, with all the crypto bills up this week, that people like the AAJ and others are very concerned about the lack of consumer protections at the state and local level, only existing at the federal level with an SEC that's been gutted and an FTC that's been gutted. Donald Trump isn't always selling access, he's also selling our national security. The Trump administration moved quickly to loosen regulations of cryptocurrency ventures at the SEC and the Justice Department and other agencies. The president disbanded the National Cryptocurrency Enforcement Team at DOJ, which famously brought cases against North Korean hijackers and other hackers and other crypto criminals. Now malicious actors around the world don't have to worry about U.S. investigations and enforcement, and they and anyone else can directly invest in the president via his personal cryptocurrency ventures. Mr. Frayer, do the loose regulations applied to crypto markets include safeguards against purchases by foreign governments, purchases by criminal enterprises, or other unscrupulous buyers?
They don't, and it's important to remember, we have already had peer-to-peer transactions in the past. They were called bearer bonds, and they became so famous for money laundering, for tax evasion, and for bribery that they were the plot device of about 50% of the 80s movies, action movies. So we've had this before. You can't have different regulation of these types of instruments.
Mr. Frayer, I introduced market structure legislation 3 or 4 years ago on crypto. And in the meantime, it means every single day I have gotten emails about people's crypto assets being stolen from wallets. The amount of hacking and theft, and I'd love for you to comment on how the individual investor, with all due respect to Coinbase, which may be the gold standard, protects themselves from having their assets stolen.
I think that's a real challenge. I think the technology to use crypto on your own in a self-custodied wallet for just peer-to-peer transactions is really hard and really risky, and that's why most people who transact in crypto use these large platforms, large intermediaries like Coinbase and Binance to do these transactions, which is antithetical to what crypto is supposed to be for and why it's supposed to be treated different.
The decentralized has become centralized.
Absolutely.
Just days before his inauguration, President Trump issued a meme coin which he told investors was worthless. I'm quoting him. He stated that the coin was, quote, not intended to be an investment opportunity, end quote. But then, shockingly, he received $350 million in trading fees and other revenue using his official platform to inflate his personal fortune off a worthless token. It generates no benefit to the American people except for his immediate family and business partners. The American people are very concerned about elected officials self-dealing. Do you think it's important to crack down on this kind of self-dealing, as is already done in the traditional financial markets?
I think American people dislike fairness, and they especially dislike elected officials profiting from their positions. It's why there was such huge bipartisan support for the Stock Act in 2012 to prevent trading from Congress members, and I think people want that for the president as well.
And I'm a proud co-sponsor of that act, and I yield back.
I want to thank the chairman and thank my dear friend, the ranking member. I'd also like to thank all of you for being here as witnesses today. Under the president's leadership, we have had an incredible opportunity this Congress to ensure that the future of cryptocurrency and decentralized finance innovation, as well as wealth creation, takes place here in the United States of America. The first step in this process was overturning the DeFi broker rule, which would have fundamentally changed the business models of America's self-custodial wallet and software providers, while overwhelming the IRS with billions of new information returns and infringing on the privacy of tens of millions of Americans. Now, we had the vote out of this committee. Didn't have a lot of my friends on the other side on the committee when we voted it out, but we were able to get over 72 Democrats to support us on the floor. And I was proud to lead that legislation. And it is fitting that the Ways and Means Committee produced the first piece of cryptocurrency-related legislation ever to be signed by a president of the United States. Now, the rationale behind the repeal of the broker rule was that there was significant differences between decentralized exchanges
and centralized exchanges, and how they should, in fact, be treated. Mr. Somensatto, can you please describe the differences between the decentralized, and I think it's important for people that are actually logging in and listening, between the decentralized and the centralized exchanges, and why the differences are important to consider when making policies decision in this space?
Yeah, thanks for the question, and we greatly appreciate your leadership on the broker rule repeal and on the 6050I issue. As has been discussed, right, there are intermediaries in this industry who look and act a lot like traditional financial intermediaries who take custody of customers' assets and route transactions on their behalf. But the kind of novel and unique element of the cryptocurrency concept, and as it's been adopted by this industry, is the ability to write and deploy code that allows for a wide variety of forms of peer-to-peer transaction. One particularly popular area has been the development of code on blockchains that allows for transactions to occur in a peer-to-peer fashion to exchange assets. And the broker rule, as it was introduced, would have blurred the lines between those two types of activity. One is software-supported peer-to-peer types of transactions, the other traditional financial institution type intermediary action. And it is a difficult issue in some ways to draw that line and requires a lot of education because of the novel way that these networks have worked, but really encouraged both by your leadership and by others in the House in terms of trying to get that distinction correct.
And I want to thank you for that. And lastly, I think it is important to highlight the job creation that is stemming from the growth in the digital asset sector. I mean, I don't think there's any mistake about that. Data actually suggests that Bitcoin mining, just one component of the digital asset industry, has generated over 31,000 jobs and contributed $4.1 billion annually to the U.S. economy. The projected total revenue related to digital asset is expected to reach over $16.1 billion by the end of 2025. Ms. Mersinger, can you speak briefly, and you only have 48 seconds, the benefits in embracing the digital asset industry could have on the job market here in this country?
Thank you for that question. And this is a great question for me to highlight that we at the Blockchain Association, we have over 130 members who are always creating new jobs. In fact, we have a member job board that has well over 2,000 jobs and is growing every day. So that's just an example of the level of growth in this industry and what having clear rules of the road, whether it's in tax or for regulation, can help continue to grow and invest in that innovation.
Well, listen, I want to thank you again, for all of you, for being here today, and again, thank the ranking member and thank the chairman, and with that, I would yield back.
Thank you, sir. And I think, am I going, Mr. Horford?
Thank you, Chair Schweikert, and to the ranking member, Ms. Sewell, for starting this important discussion today. As many of my colleagues know, I have long supported the adoption of cryptocurrencies and blockchain technologies since my time here in Congress. Why? Because these are tools that can help enable financial inclusion and equity. In Nevada, over 6% of the residents have no bank account. In the United States, 5.6 million households have no checking or savings accounts. Without bank accounts, it's nearly impossible for individuals to save money securely, let alone invest, leaving them vulnerable in emergencies. That's why it's important that when we see these new opportunities like crypto, that we push for full financial inclusion, as with any emerging industry. Congress has a duty, though, to evaluate what truly serves the public, not just what boosts big portfolios or billionaires. So let's be clear. The status quo isn't stopping Donald Trump or other scammers. We must have regulatory frameworks that allow for safe experimentation while keeping bad actors and scammers out. This week is a good start with the crypto bills that are on the House floor, but true policy making means that this is only the start. Greater access to these technologies must be balanced with sufficient standards, guardrails, and protections to allow for responsible scaling, growth, and opportunities. That's why I'm urging my colleagues to work with all of us here. I plan to lead an effort to address the taxation of cryptocurrencies, and I urge my Republican friends to join me. The American people need to know that we are united to make sure that we get these policies right. We've already seen what happens with partisan-only approaches. Ms. Mersinger, in your testimony, you noted that the gaps in our tax framework forces innovators to make difficult choices on ambiguous interpretations of the law. Can you give us an example of one of these issues innovators face, please?
Thank you for that question. And I think staking is a good place to look at one of those areas where, because of the way that tax treats the staking of assets, because it's taxed at that moment, you have innovators who may hold off and not participate because they don't have the funds to pay for those taxes up front. So it does keep people out of certain functions if they have to pay a tax at the moment of creation versus at disposition of the assets when they would have the funds to pay those taxes.
And what are the risks of inconsistent state-level tax treatment of crypto? And how can federal guidance help harmonize those approaches?
Yeah, absolutely. Anytime you have a patchwork of regulation, it just means there's more compliance costs for these businesses, and for every dollar that they spend on compliance, that's one less dollar that they're putting back in the business. So this is it's a great example of why we need it's the three-legged stool. We need federal regulation, market structure framework, we need stablecoin legislation, but we also need clarity in the tax treatment of digital assets and to ensure that America is the place for cryptocurrency and this industry to grow.
What are the benefits for both taxpayers and the IRS of treating mining and staking rewards as property, capital assets, rather than immediate income?
So kind of back to that, having the funds to pay the taxes up front when you've created something, you haven't yet disposed of it, so you don't have those funds to pay the taxes. The IRS, because of the way this is also the way you track it, you have to know the moment of the stake and the mining, and that gets to be very burdensome to track that information. And the IRS then has to they have to keep track of that as well. So it's a burden. These things happen regularly. So to have that level of disclosure and the need of that information and data to the IRS definitely will overwhelm the system. And at the end of the day, we just need some fairness in the tax code. We need to modernize it to make sure that that the digital asset framework and regulations are built on American values.
Thank you. Well, I hope that I can have my colleagues on both sides of the aisle work with us, because without clear tax rules, digital asset users face complex regulations and burdensome IRS reporting. We should all agree that we can work together to streamline that. I will yield back. Thank you.
Okay, thank you, Mr. Chairman and Madam Ranking Member. Thank you so much for holding this hearing. Thank you to the witnesses for being here today. I'm trained as an attorney and a CPA. I'm a member of Congress. I was a mayor. I was a county executive, and I have a hard time understanding crypto. And I think that most Americans are in a similar place. I know that it's a new and important industry that's growing all over the world, and we don't want to lose the advantage here in the United States of America. I'm concerned about an underground economy and not tracking things properly. I'm concerned about giving benefits to this industry that are not enjoyed in other industries. I'm concerned about the idea of creating this massive amounts of wealth when sometimes there's really nothing there. There's no there, but we're creating this enormous wealth. And I'm concerned about de minimis only because it triggers with me what happened with de minimis when we think of tariffs, that we let people not pay taxes on goods under $800 when imported from a foreign country, and people drove a truck through that loophole and they abused the system. And I can see people, you know, and you know better than I would know. I really don't understand it. If people would use the $300 de minimis idea and then try and make a business out of that and just say, let's do a lot of transactions that are under $300 and make a little bit on each one, but let's do lots of them. So I want to promote this industry. I don't want America to lose the advantage in it, but I have those concerns that exist. And I really don't understand it well enough, and I don't think the American people understand it. So I'm going to ask, I've got 3 minutes left. I'm going to ask Mr. Frayer to go first, and then I'm going to ask each of you if you want to just tell me, what is it we really have to be watching out for, to be really careful of? But you got to try and go quickly.
Sure. So I think what we need to watch out for is disparate treatment of these assets versus the rest of the industry. I think if you get that right, if you bring them up to the same standard, then we won't have this issue where, for example, we already have crypto companies out there issuing cryptocurrency that looks exactly like stock. It tracks a stock price, but it doesn't get treated as a security, and it wouldn't be under a security under the Clarity Act. If you create that kind of loophole, like you said, money is going to flow through it. And we will see not just crypto, but the regular financial industry slide through that loophole so it gets better treatment under the securities laws or the tax laws or the commodities laws.
Okay, good. Mr. Somensatto, what are you concerned about that we really have to be careful not to let it get abused?
Yeah, well, I think from our perspective, we're always looking out for the individuals who want to use these networks and the developers who help create them, and that's really where the innovation and the promise of this industry comes. And so I think your concerns are right to not ensure that some of these exemptions, for example, with de minimis get abused by businesses to run it through. I think that can be done with good policymaking, but I think it's really important to focus on kind of the individual users and the developers behind these networks.
Ms. Mangiero?
Yes, thanks, Congressman. I would say that 65 million Americans now hold cryptocurrencies, and I think, like you, though they may understand the technology, they have very little understanding of the tax framework and how it applies. So what we really need is technology-neutral application of these long-standing tax principles and a clear framework that everyday Americans can work with.
Ms. Reilly, nice to see you.
Yep, nice to see you. Thank you, Congressman. I think carefully looking at the various use cases of the digital assets, to reiterate something Mr. Frayer said, if it's an investment asset, make it consistent with the way investment assets are taxed under the code. If it's being used, such as a payment stablecoin, perhaps that requires looking at it differently and how are similar assets treated.
How would we distinguish an investment asset versus one you're just using for transactions?
Well, I think if, for example, if you're holding something as an investment, such as through an exchange-traded product, you're holding it long-term, that is different. And that's what's really challenging with digital assets. You can't pay for a cup of coffee with a security. So there needs to be careful consideration about how it's being used in the hands of a given taxpayer. And I do recognize that presents major challenges when you're developing legislation, but I think that's a key point.
Ms. Mersinger?
What concerns me is that every dollar spent on tax compliant, every dollar spent on CPAs, on lawyers to comply with the current tax code is one less dollar that is spent on these small businesses growing and innovating. And those 2,000 plus jobs I mentioned on our job board with our members, those either go away because that money is spent on compliance, or they go to another jurisdiction where there's more certainty and more clarity in the rules, regulations, and application of the tax laws.
Okay, I just push back on that one point at the end because, everybody's got to comply with securities currently, and they're making a lot of money. So, people, it's at different levels. We have to protect people, obviously, and we have to try and balance our desire to create this industry and to make a lot of money. We were all for making money. I'm a democratic capitalist. I'm not a democratic socialist, and I'm all for that. But I want people to be protected, and I'm worried about this underground economy. I'm worried about people scamming the system. I'm worried about people driving a truck through the loopholes that we create. So we have to try and find some balance between our desire to keep the economic engine moving, but at the same time protecting people to make sure that they're not taken advantage of in this process and people are not scamming the system. But thank you all for your testimony. If we could all work together, we could be so much better as we address this issue, instead of everybody just fighting with each other. So thanks so much.
Thank you, Mr. Swazi. All right, now it's my turn. And one of the great things of when they're crazy enough to let you have the gavel is, I have lots of questions, so I hope you guys didn't have any lunch appointments or anything. No, I do want to actually walk through, just because I want to get my head around, as my concern before. This is the tax writing committee. There's things I like and don't like, but that's not in our jurisdiction. Our job right now is almost to do what Mr. Swazi just touched on, and that is, how do I get my tax rules to actually be rational in something that, let's be honest, a year and a half from now, 2 years from now, one of your members, someone you know, something you're going to read, has a new innovation. Can we design policy so it has enough flexibility in its lack of being hyper-prescriptive, so it doesn't either create arbitrage of an innovation or impairment of future innovation? So I want to walk through a couple things just to make sure I get my head around, because a couple of you touched some things that I understand, just the basics. So let's talk about wrapping and unwrapping, just sort of that. First off, let's get our definition. That is when I take, let's call it my coin, and I pledge it to maybe another platform. So most of the time when I've actually looked at this, read it, I need a smart contract within there. But in my understanding, there may be some occasions where I don't need, the little smart contract attached. You actually touched on the wrapping and unwrapping. First off, is my definition simple enough to be accurate?
It's simple enough. It's exactly the explanation I would give as well.
Is there such a thing where I could do, let's say, a wrap, a pledge, and I don't need a smart contract tracking it?
I am not certain. Jason probably is the expert here, and I am going to turn to him.
Oh, it's always get stumped on poor Jason.
I used to work at the commission with Commissioner Mersinger. So yeah, when you're talking about wrapping, you're usually talking about using a smart contract, which is just code that is operating on the blockchain to change, literally you have the same asset, it's just kind of exactly as the term is used, wrapped in a different form so that it can interact in a different way.
It's an asset to pledge to another platform's asset.
It doesn't have to be necessarily to another platform, actually.
Okay.
So it can be just within the same, on the Ethereum platform, people wrap ETH into an asset that they call wrapped ETH for use in other forms of smart contracts, because that's kind of the acceptable currency, even though it's at an underlying level really the same asset from an economic perspective.
Okay, so now you took me almost exactly where I wanted to go. One of my disappointments is being someone who actually had intense interest in ledger design. You have the programming background. If you and I went back 15 years ago, I had this crazy vision that identification, documentation of certain benefits someone holds, not only lowering the cost of transactions, was actually going to be much more egalitarian. It was going to help the poor. It was going to help, friction and cost of moving money and those things. And I understand much of the programming talent in the world sort of went to where there was money to be made. Smart contracts associated with that wrap or unwrap. What's its tax implication?
So when you talk about that wrapper, we have wrappers. An ETP is a wrap of a commodities product into a securities product.
Okay.
So you just look at it the exact same way.
Okay, so we're comfortable that treating it as the security product, that hey, this is the pledge that its value.
It's the same concept, so I would do same treatment.
Jason?
I would think it's a little different, right? When we're talking about what is happening in a wrapped situation with a smart contract, we're talking about a technical process, right? These are neutral technology tools that people can use to design a variety of different assets or use cases. With an ETP, you're talking about creating a financial product that you're trying to sell to a user. And so that's not to say you can't use this technology to create a financial product that you're going to sell, and that should be treated as such. But I think there's nothing inherent in the technology and how it works that necessarily requires a particular unique treatment for interaction.
So you think our current baseline would work, and I'm not going to have leakage there?
I think that's right. I mean, I'd have to think about that and
I almost
go
need
into
to whiteboard, and I'm sorry, I don't mean to be geeking out with everyone, but that's actually part of our job, is trying to figure out how freaky smart people might try to get away from the tax man.
I think what you're trying to do is identify when the economic character of the asset has changed,
Yes.
right? When we're talking about a smart contract, we're usually not talking about change, or with a wrapped situation, we're usually not talking about changing its economic character. There are other interactions with a smart contract that would do that, that deserve maybe a different attention.
Okay, if any of you ever come across an article or something exactly to that, I'd like to make sure, because it's something we haven't really, with staff and others, have much of conversations of pledges with smart contracts or vice versa. Is there any way to roll my basis or other things within that? And I actually have a little model we've been playing with a couple of smart people that are friends of mine on how they thought they could actually roll their game using a series of smart contracts. So it's really geeky, and they're much smarter than I am. How about third-party pledging? Or third-party staking? Anything there, do you think, in both what you see coming out of financial services on the definitions and how we would recognize when there's a tax strike or an obligation? I'm staking, but also I'm now using, I'm taking and pledging to a third party and letting them hold my stake. Anyone?
Yeah, I mean, I think if
comfortable with
you're talking about you can stake in many different ways, right?
Correct.
So you can stake yourself. If you're someone like me who doesn't have the technical knowledge to engage in staking, right, or the time, then I can engage a third-party staking as a service provider, some of which are custodians, some of which are not. So you can engage a non-custodial delegated staking as a service provider. And so I still have ownership of those tokens. I'm just engaging this service provider to engage in the staking
So
part.
no change in who would hold a tax obligation if there was value gained?
No.
We're all comfortable with that one? Look. Oh, no, go ahead, please.
With regard to third-party staking, though, I think we should look at the arrangement here. And essentially what you have is you have an aggregator of assets investing in a process, so managing people's pooled assets to make a gain, and then distributing that gain, whether that's interest from loans or the money gained from staking, to the participants in the pool. And I think the ranking member, as a securities lawyer, can probably suss out what that is.
That was actually close to something she and I were discussing, which apparently I had left the mic on. So,
Well, I would just add, though, according to the May 29th guidance that the Division of Corporation Finance put out at the SEC, they said that protocol staking and certain ancillary activities necessary to do so are not securities transactions. For pooled staking, that should be looked at differently. This also kind of relates directly to what they said about proof of work mining. So this pooling is not worrisome because it's a technical service. So all of this to say, it's a complicated discussion, and I'm sure we'll talk about this more.
There's some weird offshoot, and this isn't probably the proper place, some fee income. Hey, I created this, it's going to go out as a loan. Is there a fee, not only to the loan, but outside?
They take a portion of the staking rewards that are generated as a fee for the services provided.
Okay. Be prepared. I'm sure some of and thank you for complimenting the staff before. I think that's something we often fail to do enough of, and you being there, because it's not like we don't abuse them. And to my staff who's kept me hyper caffeinated, thank you once again.
And me too.
Yeah, Jerry too. Do be prepared over the next, we're going to do it, what, over a week, 2 weeks of, 2 weeks? Oh, I hate it when they have to give me a script. I should have these things memorized by now. But be prepared for a number of questions that may come your way. Also, when you get questions from us, be willing to also say, here's references, here's an article, here's actually someone out there that has both the securities background, the tax lawyer background. I have an intense interest we get this right. I look back to prior to 2008, we had a chance to get some things right in 2006, and we didn't do our language on securitization, transparency, and those things, and it cost the world trillions of dollars. If we get this right, this is an industry that I think actually has some nobility, but it's going to be more than just people making money because they issued a coin. I have this fascination of how we make our IDs bulletproof, how it becomes a way where the con artists out there that are stealing from wallets, stealing from others, we can shut that down. But also another thing, and I will ask for any of you in your collective wisdom, you know I have an interest with one of my Democrat colleagues of coming up with de minimis that actually works. But I believe in an age of technology. This isn't armies and rooms full of people looking at the data coming back and forth, that it's almost auto magic. It will be the algorithm and a little bit of AI mining that will watch the data coming back and forth. But with that, we have to sort of have the rails built and how we design the tax rules. So as my little girl uses the term auto magic, we can do this, but we have to be, and there's my difficulty. I want something that doesn't impair the future, but I want to be prescriptive enough to help the taxing authorities and Treasury know what the rules are. And you understand sometimes these two ideas conflict with each other. So with that, I'd like to say thank you for giving us your time. Be prepared for a series of questions over the next week or two that may come to you in writing. Please respond in writing. And if you have any articles or other things that will help educate us and our staff, please send it our way. And with that, the hearing is adjourned.